I want to turn it over to you now, Keith Springer. What did you take out of this announcement?
Well, what's clear to me is that the Fed didn't want to look like they were panicking. I think they know they have to. I think it's clear they see slower economic growth. A few months ago, they were blaming it on Japan and the weather. Now they clearly see a slowdown in the economy, but I don't think they wanted to come across as trying to panic the market into thinking that they had to take action. And I believe they're trying to create some form of stability. What they're doing is continuing with what I call QE mini-me. It's a reinvestment of the proceeds and interest of the existing bonds, which are still $25, $30 billion a month, which is still significant. Lower interest rates for another year and a half, 2 years is very significant. It's a lot of liquidity into the economy, but I still think the emotional aspect of the market was looking for more. And the headwinds, like I talked about in Facing Goliath, the headwinds are so great that they're going to have to create much more aggregate demand, or we're going to see continued sell-off, and I'm really worried about that.
We're going to bring in now Neil Cavuto, who I believe is standing by, the Senior Vice President and Managing Editor of Fox Business. And Neil, as we now look at the screen, you can see that the markets are back up almost exactly where they were before the policy statement came out. What did you pick up on? Did you get a sense that the Fed is willing to come in and prop up with the support of a possible QE3, like some people out there are reading?
Well, I guess I'm more startled by the fact that the Federal Reserve, long known for, decades, not being able to telegraph what it's going to do in the next 2 days, is now indicating what it plans to do in the next 2 years. That is essentially nothing when it comes to short-term interest rates. And, if you're a stock trader, how do you respond to that? You probably respond, as they appropriately did initially, negatively. That means this slowdown that we suspect was going on was and is pronounced and is going to linger for a while because the Federal Reserve has all but said so. Or do you then think about that, get over the reality of that, and then say, well, look at the bright side. Short-term interest rates will be this low for a couple of years, and that's a net good. Now, I don't know how they battle this out in this civil pack back and forth. Do I trade up or trade down on this? I think it is remarkable, though, that Ben Bernanke has sort of entertained another arrow here, where he could telegraph to the markets, look, I know you're worried about where interest rates are going. What if I told you for the next 2 years they're not going anywhere? And maybe that calms the proverbial savage beast. I don't know. But I did have the pleasure of listening to you guys earlier, but I think that's very unusual, dramatically so, and introduces a whole new Federal Reserve posture. It's one thing for this being the year that the Federal Reserve is at press conference and the like, but this is very, very unusual. This isn't being opaque. This is being very direct, and that part alone startles me.
Well, I mean, but Neil, should you be startled in a bad way or good way? Because yesterday,
I don't know, Charles. That's like I said. I could see the good and the bad in this. I could see the original panic that ensued right after this because they're saying, "Oh my God, he's talking weakness for a couple of years." That is Ben Bernanke. Then you could flip around and say, "Well, we suspect it was weakness, but the flip side is interest rates stay very, very low." I don't know. When you step way back from this, Charles, I think you look at this and say, things are weak. We were downgraded this week. We barely got a debt deal done. We know the debt deal we got done was nothing to write home about. We know the economic numbers are slowing, and now we got confirmation from the Federal Reserve that it's going to be this crappy for another couple of years. I don't think that's anything to party over.
It's not anything to party over, Neil, but how about the fact that they're being straight with us, whereas yesterday I think that Wall Street said, you know what, no one's being straight with us. At least they're saying we know things are bad and we're going to accommodate you.
There is that. For years, you've had teachers in school who were trying to hint to you that, maybe you weren't geared for this. You needed someone to be direct and say, Neil, about your astronaut ambitions, you can't fit in a capsule. Give it
What
up.
was the helmet, not the capsule?
Right,
just the helmet.
But my point is, in all seriousness, I think there is something we said of a Federal Reserve that just lays it out there in the starkest terms I've seen yet. Very unusual because it kind of now is saddled with this responsibility of sticking to it when we all know that environments can change, inflation can appear out of nowhere. They've given themselves a couple of outs here, but very, very few, and not enough to at least raise concerns if they have to abandon this policy.
Thank you, Neil. And now we want to toss it over to the rest of our panel. Keith Springer, some final thoughts before we go.
Well, I like the fact that they didn't panic, and I do like the fact that they're being honest up front. But it's clear the market's down, what, 16, 17% in the last couple of weeks, and what do we have? A very feeble rally off of those statements. It's clear that the market was looking for a lot more. It's clear the economy needs a lot more. We have tremendous slowdown, no aggregate demand. The Fed is going to have to step in. This QE mini-me of low interest rates, continued purchases of the proceeds of the bonds, is enough to maybe keep us out of recession, but not enough to provide any form of growth for the economy, and no push for the stock market anytime soon that the market really needs, that emotional push that it's really looking for.
All right.
And I think that's what it was looking for.
I wish we could have gotten to the rest of the panel, but we are running out of time. Keith, Marvin, Phil, and Nicole, thank you so much for being with us. Just want to point out what's happening with the markets.